Do you have a desire to build wealth? Of course you do. What if I told you that the old saying, you can't beat the market, is complete BS? I don't just show you where, but how to be a contrarian investor and hit your investing goals out of the park.
If you're a mining investor and you've ever wondered if there's something you're doing that's, not quite right with your portfolio, let me tell you, you are probably right. Now, over the years, I've spoken to a ton of investors like you and me, and I know the pain, that feeling of such and such person picked the right stock, and I picked a duster and I don't really know what I'm doing. I've lost so much money in the sector. What am I supposed to do? There's still a twinkling of hunger in you because you want to get things right. You want to pick more winners, but at the same time, you feel a little bit discouraged because there are so many red numbers in your portfolio that you think, what am I doing? Is it time to change strategy? Is it time to get a strategy, et cetera, et cetera? And so there are a few things that have stood out as traps that I have either committed or my friends have committed that I want to tell you right now so that you will start to look at your portfolio through those more educated, war torn eyes. There's no better way to say it. Let's face it. I've had experiences where, for instance, I bought a stock. I want to tell you about this one. This is an interesting one. I bought a stock and it was in a very interesting region. There was actually a neighboring company that had really good results. And I can't remember if it was the neighboring company, and this was a closeology play, when a company just gets land close to that region, or if it was the actual company I was making a bet on that had really, really positive trenching results. So they basically go and dig a trench and they go and assay those for, I believe it was gold, some silver, but mostly gold. And they were awesome. The results were amazing. And so I wouldn't blame anybody to get really excited over that story in that region. It kind of did help in a sense that I'm somewhat familiar with the region in that I got married there somewhere in Mexico. And I think there was a little bit of an emotional side to it of, hey, this could be like the next big thing. And then we buy shares in this. And then, we can go down and visit because, we have this timeshare in that town. And so you start to think about things. And so I think there was a little bit of an emotion there that was based obviously on fumes. But the fact was there was apparently great geological potential. And then this company does a raise. And so I participate in the private placement. And they come out with the results of the drilling, the actual drilling, not trenching, no surface nonsense, just, actual holes in the ground. And all of the holes were dusters. Like they couldn't find it. They couldn't find anything. And the stock just immediately collapsed. And at the time, the money that I put into it actually made a difference, as my computer will testify to it. It did make a difference. And most importantly, I didn't know when to sell because I thought, hold on. The 4-month hold period from the private placement had already lapsed. And so I was selling it. And so was everybody else. And they didn't really have a plan B. And I don't believe that they had other projects in the pipeline. It was just that one project. And it was, it was a drilling campaign. It wasn't just geophysics where you overlay all the maps and you're looking for targets. It was just like, this is it. And I had no idea what was coming next. But at the same time, the pain of seeing the stock collapse so quickly made me freeze. And I didn't sell it until I was down, I think 90%. I don't like talking about it, but I think I lost 90% of my money. And could have done something else with that money, could have turned into something greater, like put it towards Encore Energy, which went up 34 times. Anyway, so let me go through a few different things so that you don't fall into either this or a few other traps, which I'm sure if you've committed any of these small but common crimes, I want you to comment below as you see them happening. Number one, uno, is FOMO chasing. Now, I'm kind of good at not going for this one every single time, but once that I have stopped myself, or every single, no, let me backtrack. This is wrong. Every single time I have made this mistake, I have lost money, except for once, which I'm not going to talk about just yet because it's a developing story and I haven't sold it yet. So I don't want to jinx it. Okay. I don't want to jinx this. FOMO chasing is when you see that your portfolio is not getting much love or excitement. And there is either a rumor or a discovery or a development happening. And another stock is going up very quickly. Very quickly. It's got to be to a point where you feel annoyed that other people are winning and you are not. That is the heart of FOMO. And then what you do is, after you've seen enough and suffered enough and that price has gone up enough that you're, then you buy. And then what happens invariably is you're the exit for somebody else who was holding that stock when the stock went absolutely nowhere. And then it drops, right? FOMO chasing is the number one crime of people who were really meant for longer term investing, like myself. I like to take my time doing my research. I want to have weeks to look into something and buy it or not buy it and make a decision. And I am willing to wait and hold for months to years, usually. And the fact that something's moved up day after day after day makes it out of my league, because I am envious of the people who got in at the bottom, but I know that the only way that I can beat them is by being in at the bottom somewhere else. And then I take my little bag of money and try to find the other stocks that might eventually move up, but not the one that's already moved. If it's already moved, I'm like, can't do it. I can't chase it. And one of the reasons why I don't recommend you do it is usually the type of person who's meant for longer term investing isn't quick enough to act on the type of trading in and out that you need to have, the skills that you need to have in order to, day trade this thing and then maybe make a quick 20, 30, 50%, whatever it is. Some people make quick 300%, but they have to be on the ball and follow that stock. And I don't want to just follow a stock and its moves and do technical analysis, on like really short-term charts and make decisions like that in and out. I want to have time to think. It's not for me. It's just not for me. I tried it. Trust me. Lost money. Not recommended. 0 stars. Point number 2 and trap number 2 that you should avoid at all costs is selling too soon. Now, this is why it's so hard to buy when something has already moved, because then you need to sell really soon. But the money in mining and most high risk, high return investments is that you're making a bet on the tide turning to an extent where people will come to the same conclusion that you have, and they will pile their money onto your thesis, your stock, whatever. And if you sell too soon, then guess what? You miss out. Now, do talk about certain commodities, things that I like, things I don't like. And there is a very big difference in the easy money that's made from the bottom to the middle and the quick money that's made from the middle to the top. Now, do realize the choice of words here is very, very intentional. Easy for some people is to hold from bottom to middle. Quick, not easy, it's to hold from the middle to the top. But you make more money at the end of the move than you do at the beginning. And so if you give a thesis, say 18 months, but it takes 3 years to pan out, what happens is you might make 20% on your money, you might make even 100% on your money, but that means that if you zoom out on the chart, like, well done. You've made the first little curve and then you miss the blow off top. Now, this is not to say that everything you buy will have a blow off top. This is beyond, the topic of this video to talk about blow off tops, bubbles, etc. But ideally, you should be putting your money into things that have a likelihood of having a blow off top. You want to bet on bubbles that haven't popped yet. That's where you make a bunch of money, right? In things that are due to get really hot, not things that are already hot right now. At least that's the way I see it. That's how you become a contrarian investor, and that's how you make lots of money in this space. Now, trap number 3. Trap number 3. There's 2 sides to trap number 3. I'm going to present you both. You're going to tell me which one you're most likely to commit down here in the comment section, okay? Deal? Deal. Okay. It's spreading yourself too thin or concentrating yourself too much. Portfolio sizing is so important because on one hand, you need to only have enough stocks that you could really follow the stories of each stock on a daily basis, if possible. But on the other hand, if you make a bet on a really bad company and a really good thesis, or just one region in a thesis, or just one type of company in a thesis or a commodity, the whole sector might move without you. And there is nothing worse than getting a theme right, getting a thesis right, doing your homework, buying into uranium, copper, gold, platinum, helium, whatever it is, and then concentrating your bet on that one company that does nothing. It's like, congratulations, you have spent time, money, energy. You were right, and you still did not make money. Absolutely heartbreaking. So make sure that when you look at your portfolio, you only have a handful of stocks that you can follow with your time and energy. But at the same time, you don't concentrate everything on size of company, on jurisdiction. Hello, Athabasca people. Hello, Africa only people. Hello, USA only people. Speaking to myself here. And make sure that you don't concentrate on too few companies, or else that's the risk that you run. Okay. Number 4. What is trap number 4? Well, it's not having an edge. And this is the toughest one to develop because some people think that having an edge is having so much knowledge in something very particular about an industry that it makes you completely unique. That's not true. For example, my edge in mining is that I am willing to buy when the patient has flatlined price-wise, and I'm willing to hold until a thesis plays out. That's it. I do not have the upper hand on knowing everybody in Vancouver. Trust me, that's an upper hand. That's a hell of an edge if you can get it. I don't have a technical analysis edge. In fact, I think most purchases I've ever made where I've actually made some money, all the technical traders would say I'm insane and should sell my positions immediately. I don't have a technical edge of the deposits. I don't have an engineering background whatsoever. So a lot of the typical edges that you would assume that you need in order to excel at this industry aren't really necessary. Now, there's also something that I really enjoy doing, and that is looking into people and making assumptions and trying to use a tiny little bit of human psychology in order to ascertain if a company is going to go anywhere or not. For example, there's a company right now I'm looking at. I haven't bought it yet, but it will not be named. A few of you know which company I'm talking about. It is owned by a group of people, which is very typical, okay, of these mining companies. And this group has come into an opportunity to expand their marketing efforts in a way that has never been done before. This company is sitting at very close to cash levels within a commodity that is getting decent amount of love. A company like that kind of ticks a lot of boxes for me. I'm not going to be talking about it right now. I still have to speak to management and get a few things clarified. But that's my edge. I look at people, I buy low, and I try to hold. And that's it. I'm not really the best at any of those things, but I know that human psychology dictates that if you are not careful, you're going to be FOMOing into a company I already own. So don't do that. And make sure that you have an edge. Maybe your edge is that you do really deep analysis. Maybe your edge is just technical analysis. You look at charts and you can tell what's going on. Maybe you look at historicals and, seasonality. Maybe you have a good macro vision. Maybe you are more technical and you have a geological background or an engineering background. Maybe you have some different sort of knowledge that I can't really think about. Use it and accept that your edge needs to be used over and over and over again. You will be offered opportunities where your edge will not be necessary. It will make no sense. It won't come into use. And usually those are the opportunities where you won't make as much money. I'm just saying. So take that as you will. Now, if you agree with any of those things and you've made some good returns in this, but there's still that little bit of exit strategy missing, then watch this video because we talk about exit strategies and it's really good.